Welcome to this explainer. Right off the bat, I want you to put yourself in the shoes of a client, and I'm going to act as your personal financial advisor. Today, we are conducting a full-blown audit of the U.S. national debt. And most importantly, we are going to decode exactly how it impacts your personal bottom line. You know, the national debt is one of those massive macroeconomic concepts that can feel so distant. But as you'll see today, it has a direct line right to your wallet.
So let's kick things off with the million-dollar, or I guess trillion-dollar question. When exactly does government borrowing cross the line? Some government debt is actually a healthy, normal part of a functioning economy. But at what point does it pivot from being a useful financial tool to a genuinely harmful burden on your personal finances and the wider economy?
Here is our game plan for today's fiscal health checkup. We'll be reviewing our national balance sheet, analyzing the impact on your savings and loans, exploring the drop-dead debt limit, and finally, mapping out the path to fiscal stability.
Okay, Section 1, our national balance sheet. Let's open up the federal ledger and look at the reality of where things stand today.
The sheer scale of the numbers we're dealing with is just staggering. Congress has run a budget deficit for 20 consecutive years. 20 years! And recently, a massive $1.8 trillion deficit in the 2020s was slapped onto our running total. When you look at this debt as a percentage of our gross domestic product, which is really the most accurate way to measure our ability to carry it, we are now sitting at debt levels we haven't seen since World War II.
Now, as an advisor, I'll tell you, we have to distinguish between good and bad financial management. Good borrowing happens during massive global crises like World War II or the 2020 pandemic. During those times, borrowing allows households to essentially save in low-risk government assets and helps maintain our standard of living when the economy basically shuts down. Bad borrowing, however, is what we're looking at right now. Our current structural problem is that we just kept on borrowing massively when there was no crisis at all. We are carrying a World War amount of debt completely without the World War.
Moving right along to Section 2, impact on savings and loans. Let's see exactly how this macroeconomic borrowing hits your personal bank account and limits your opportunity to build wealth. In finance, we talk a lot about opportunity cost, and the debt brilliantly illustrates that concept on a national scale. When investors buy U.S. Treasury securities to fund the national debt, they are handing their money over to the government. Think about what that means. The reality is, the government is actively competing with you for capital. That's $1.8 trillion diverted away from corporate equity that could help businesses innovate. It's money not sitting in local savings accounts where banks could lend it out to fund your personal mortgage. It's capital just being absorbed by the government instead of making our private economy more productive.
And the long-term toll this takes is steep. Because federal borrowing crowds out economic productivity, studies actually project that if we took the steps to reduce the debt, personal incomes could be nearly 7% larger by the year 2050. That is a massive amount of future wealth simply erased from your potential earnings, all because of the way our national ledger is managed today. You might not physically see the debt, but you absolutely feel its absence in your paycheck. Let's look at the actual cash flow for 2024. Unsurprisingly, Social Security and healthcare eat up the largest portion of the budget. But look at what comes next. The government actually spent more on simply paying the interest on the national debt than it spent on the entire military and defense budget. Crazy, right?
To put this into an everyday context for your own household, economists point out a really grim reality. We have so much debt that the government is actively borrowing money just to pay the interest on the previous debt. As a financial advisor, I would tell any client that taking out a brand new credit card just to pay off the old one is a massive red flag. It's the ultimate indicator of a portfolio in severe distress.
And here is the exact chain reaction that hits your wallet. U.S. Treasuries are considered the safest asset in the world, so they essentially set the baseline for all other interest rates. When investors get nervous about the ballooning size of the U.S. debt, they demand higher interest rates to compensate for that perceived risk. Because of that, Treasury yields rise. And since those yields are the foundation of our entire financial system, your personal mortgage rates, your auto loans, and corporate borrowing costs immediately spike. The risk premium the government pays is directly passed on to you as a consumer.
All right, Section 3, the drop-dead debt limit. If this credit card cycle continues, where does it mathematically end? Let's analyze the systemic risks.
Economists warn us that there is a literal mathematical point of no return. If publicly held debt, meaning the debt actually held by outside investors, not internal government accounts, reaches roughly 175 to 200% of gross domestic product, we hit what's considered the drop-dead limit. Why? Because at that threshold, it becomes mathematically impossible to raise taxes high enough to even cover the interest payments on the debt.
So the crucial question is, what happens next? Hitting that limit triggers what economists call the Greek-Portugal meltdown scenario. In this scenario, the economy completely stalls out, so it isn't generating enough income to tax. Suddenly, foreign borrowers panic and want their money back. Interest rates explode literally overnight. A severe recession hits. And to make matters even worse, you are forced to enact massive tax hikes right in the middle of that recession, just to appease your creditors. It is a financial trap with zero good exits.
And the truly terrifying part for our national portfolio is the timing. While 200% of GDP is an outer-bound mathematical limit, this unraveling could theoretically happen tomorrow. The trigger isn't just hitting a specific magic number. The trigger is capital markets losing faith. As soon as global markets believe Congress and the president won't get their act together to manage the balance sheet, the system unravels, and it unravels incredibly fast.
Which brings us to Section 4, the path to fiscal stability. How do we restructure this portfolio before the next crisis hits?
First off, we have to bust a very common myth right now. You'll hear some policymakers suggest that if the economy just does better, we can simply grow our way out of the debt. Well, economists are very clear. This is a myth. You absolutely cannot grow your way out of this because most government spending is already directly tied to that economic growth. To spur real economic growth, you have to solve the fundamental fiscal problem first, not the other way around.
To truly stabilize the balance sheet, experts state we need a grand bargain, and that means strictly putting everything on the table. It requires hard, highly unpopular choices. We're talking about fixing Social Security, which is headed straight toward insolvency. It requires adjusting Medicare trust funds, implementing changes to welfare programs, aggressively addressing massive waste in defense procurement while capping discretionary spending, and yes, mathematically, it requires raising taxes. It doesn't have to be draconian, but it absolutely has to be fundamentally different from our current trajectory.
As your advisor wrapping up this audit, I'll leave you with this. When the next actual global emergency hits, we already know for a fact that we have significantly less space to borrow than we did before. We are standing on extremely thin ice. So, regarding our long-term fiscal health, we have to ask ourselves, are we going to implement these difficult reforms now, or are we going to run the experiment to see exactly how long the rest of the world will wait before the system unravels? Thanks for joining me for this explainer, and keep a close eye on the ledger.